On the 10th of May 2019, Uber went public on the New York Stock Exchange at $45 a share. The company was valued at $82 billion. It was the largest U.S. technology IPO in 6 years. Cameras were there. Bells were rung. Confetti fell. The year before, Uber had lost $1.8 billion. The year before that, $2.2 billion. Over the previous decade, it had burned through cash at a scale that would have destroyed most businesses many times over. And yet here it was, being celebrated on the floor of the NYSE, worth more than Boeing. On the first day of trading, the stock fell 8%, the largest first-day dollar loss in U.S. history at the time. Investors who had bought at 45 were already underwater, and new investors were still queuing to buy in. None of this seemed to trouble the serious financial professionals who had valued the company at $82 billion. Why? Why does a company that bleeds money at this scale attract billions in capital? Why do sophisticated investors, the kind who could read a balance sheet in their sleep, pour money into businesses with no path to near-term profit? The answer is not irrational. It is a specific, deliberate logic, and once you understand it, you will never look at a money-losing company the same way again. This is that logic. To understand why a money-losing company can be worth billions, you first have to understand how venture capital actually works. Venture capital is not a business of picking good companies. It is a business of being in the room when one extraordinary company wins, and letting the rest absorb the cost. Mark Andreessen, co-founder of Andreessen Horowitz, one of the most powerful investment firms in Silicon Valley, observed in 2014 that of every 200 seriously funded startups, 15 generate 95% of all returns. The other 185 either fail or deliver returns too small to matter. Harvard Business School research on 2,000 venture-backed companies found 75% failed to return investor capital. And yet the model works, because the 1 in 15 that wins doesn't just cover the losses, it pays for everything, many times over. Benchmark Capital demonstrated this precisely. In 2011, they led Uber's Series A, investing around $12 million. 8 years later, when Uber went public, that stake was worth approximately $6.8 billion, a 750 times return on a single check. That is the power law working. And that is why a VC firm does not need every company in its portfolio to be profitable. It needs one company to be so dominant, so structurally embedded, so difficult to displace, that its future pricing power justifies every dollar lost along the way. The losses across the portfolio are not the problem. They are the price of finding the one company worth winning. This mechanism has always existed inside venture capital. What changed, decisively, in December of 2008 was the cost of money itself. The Federal Reserve dropped interest rates to zero in response to the financial crisis. They stayed near zero for 7 years. When money costs nothing to borrow, it has to go somewhere. It flows toward the highest possible return. And in the decade after 2008, that meant technology startups. Specifically, the ones racing to own markets at a scale that justified enormous early losses. Masayoshi Son, the founder of SoftBank, saw this window and decided to go further than anyone. Between 2016 and 2017, he assembled the Vision Fund, $100 billion, the largest technology investment fund ever created. Saudi Arabia's Public Investment Fund put in $45 billion, SoftBank $28 billion, Abu Dhabi's Mubadala $15 billion. The fund was focused entirely on backing companies at a scale that made traditional VC look like a rounding error. Sun described his own thesis in a single line: the crazy guy always wins. He was applying the power law at a magnitude no one had tried before, betting that bigger capital would produce more certain winners. The result was an era of investment that had no precedent. Global venture capital hit $671 billion in 2021 alone, nearly double the year before. Startups that had never turned a profit were being valued in the tens of billions. The losses were growing. The valuations were growing faster. Here is what these companies are actually buying when they burn cash at scale. Not the product, not the technology. the market structure around the product, and specifically, the ability to raise prices once that structure is locked in. Every dollar Uber spent subsidizing rides below cost in 2014 was purchasing something specific: drivers trained on the platform, cities with regulatory permission to operate, passengers who had the app on their phone rather than anyone else's. It takes years and enormous capital to build that network. You cannot replicate it overnight, no matter how much money you raise. That is the point. The investor's calculation. If Uber eventually dominates ride-hailing in enough cities with enough scale, it can then charge what the market will actually bear: higher commission rates from drivers, higher fares to passengers during peak demand. The accumulated losses become the moat. The moat becomes pricing power. Pricing power becomes profit. It is a sequence, not a coincidence. Think of it as building a toll road at a loss. No one pays until the alternative routes are gone. Once competitors run out of capital, you raise the toll. The question was always whether you could hold out long enough. This is sometimes called blitzscaling, the deliberate choice to prioritize speed of market capture over near-term financial results, on the thesis that monopoly-level dominance is worth far more than any profit you would earn by going slowly. It is not reckless. It is a calculated bet on the prize at the end, the ability to set prices that no competitor can match, because no competitor survived long enough to matter. But here's the part that most explanations of this model leave out. The investor who funds this decade-long gamble does not wait for the toll road to become profitable. They exit before that, often well before. Here is the sequence. Benchmark writes $12 million in 2011. Over 8 years, Uber raises billions in successive rounds, each one at a higher valuation, each one telling the market that the previous investors were right. By 2017, SoftBank alone has put in $9 billion across 2 tranches. The company has never been profitable. The valuation is now $60 to $80 billion. Each funding round does 2 things. It gives the company capital to keep burning, and it creates a new reference price, a statement to the market about what the company is worth. The earlier investors' stakes are now worth more on paper. Their returns are compounding on every new round. Then comes the IPO, May 2019, $82 billion. Shares are publicly tradable for the first time. Benchmark can sell. The public markets, pension funds, index funds, retail investors, absorb the risk the early investors had been carrying. The game has passed. The early money is out. SoftBank exited Uber entirely in the second quarter of 2022, selling above their cost basis. They made money on a company that had accumulated, by that point, more than $32 billion in losses. The investor was whole. The company was still in the red. In March 2022, the Federal Reserve began raising interest rates. 14 months of increases followed. Something that had been true for a decade suddenly stopped being true. Money was no longer free. When borrowing costs rise, the future becomes more expensive in a precise mathematical sense. Companies valued on the promise of profits they will earn in 5 or 10 years are worth less today, because those future profits are discounted at a higher rate. Loss-making companies that had been sustained by cheap capital found that capital drying up almost overnight. The model that worked at zero interest rates required adjustment. WeWork was the extreme demonstration of what happens when the model fails. In January 2019, SoftBank had invested at a $47 billion valuation, more than every U.S. airline except Delta and United, for a company with revenue of $1.8 billion and losses roughly the same size. When WeWork published its IPO prospectus in August 2019, investors read it and stopped. The losses were structural. The governance was incoherent. The IPO was pulled in September. Adam Neumann resigned as CEO. SoftBank deployed a $9.5 billion rescue package to keep WeWork operational. It bought time, not a future. On the 6th of November 2023, WeWork filed for bankruptcy. SoftBank's losses exceeded $14 billion, written entirely to zero. WeWork never found its monopoly. The model of losing money only works if, at the end, you have built something competitors cannot replicate. WeWork's product, flexible office space, could be offered by any landlord with capital. There was no pricing power waiting. When the capital stopped, there was nothing underneath. In 2023, Uber posted a profit for the first time in its 14-year history. Net income, $1.887 billion. After more than $32 billion in accumulated losses, an IPO that fell on its first day, and a decade of burning money across 60 countries. What changed was the competitive landscape. Uber had built a driver network, a brand, and regulatory relationships that competitors had spent billions attempting to replicate. Lyft remained a US-only runner-up. The race was over. The survivors could now price accordingly. And price they did. Gradually, the platform that had subsidized rides to build its position began extracting more from each transaction. Driver commission structures shifted. Surge pricing became more common. The economics that had been catastrophic for a decade began, slowly, to turn. The toll road was finally operational. Today, Uber's market cap sits at around $145 billion. Dara Khosrowshahi, who replaced Travis Kalanick as CEO in August 2017, steered the company from growth at all costs to something that looks, finally, like a sustainable business. The accumulated losses remain on the balance sheet as a historical record of what it cost to build an unchallengeable position. Bill Gurley, the benchmark partner who led the original Uber investment, said this in 2015. Somehow we've gotten very comfortable with the $20 million burn rate. Since when did that become okay? I think it's crazy, and it's happening all over the valley. He was right about the craziness. He was also the man who had made it possible, and who profited most from it. Strip away the terminology, and the venture capital model is something specific. It is a machine for concentrating large losses inside companies during their growth phase, sustained by investors who expect to exit before those losses become permanent, and converting what survives into market dominance that can be monetized later. The losses are not accidental. They are the mechanism. The question of who absorbs them is answered quietly, through IPO timing and investor exit decisions. By the time the model becomes legible, when Uber reports its first profit, the people who funded the losses are long gone. The public markets, the workers, and the cities are holding what remains. Mark Andreessen's 15 out of 200 is not a failure rate to be fixed. It is a business plan. The 185 that don't deliver returns are the cost of finding the 15 that do. The model is designed to fail most of the time and be right once. That is not a bug. It is the design. The harder question is what the model builds in the economy. A decade of below-cost rides, paid for by investors who expected to price the market later. Platforms now raising prices on the very customers who adopted them, because the alternatives were priced out while the losses were being run. Whether this is how we want large parts of the economy constructed, subsidized by loss-tolerant capital racing for monopoly, then extracting the returns once the competition is gone, is not a question the venture industry is required to answer. They have already answered it, with their checkbooks. The question of whether the rest of us agree is still open.